were coming and the stock market sold off again?
Yeah, we're doing fine. And about noon, we decided I was coming on, then it tanked, right? Yeah. That seems to be the best signal you and I have in the last 2 months.
Don't lump me into you, okay?
Oh, what do you mean? It's only when I'm with you.
It's a fragile market. That's the point.
Yeah, it is. And I think things are confusing. I'll tell you why. We look at about 150 macro variables across consumer, industrial, economic activity, financial conditions. Some are extremely good, some are extremely bad, most are rolling over but high. So you have some conflicting. I was sort of taking a step back thinking about it this morning. You have this disaster in March of 2020. All the data that anniversary recovery looks good. All the data that anniversaries that rolls over. We're finally kind of 2 years past the trough. I think the data is starting to normalize a little bit, and you're able to kind of compare where we are now to 2019. Seems like what was excess, what wasn't. And I think the data are starting to make a little bit more sense to me that things are going to slow a little bit.
More than you thought?
I think.
Come on, you've been more positive than most.
I think earnings are still going to grow, so that's clear to me. I think you'll probably have 5% earnings growth this year. But I think the data on jobs are deteriorating. There's no question in the last 2 or 3 weeks, more companies are talking about less hiring and firing. And I think the fact that the S&P estimates for 2022 are higher now than they were on January 1st, despite rising oil and rising commodities, puts more risk in the numbers that are in there. Right. So I think you're going to see more down revisions in Q4 than I would have thought a month ago.
This is a prove-it-to-me market now, right?
Yeah.
Prove it to me that inflation has really peaked. Prove it to me that earnings aren't going to fall out of bed. Yeah?
I think that's right, and I think July earnings is obviously going to be the moment where we see, do you get rewarded for beating? Do you get punished for missing? Where are we in that cocktail? And obviously some of the big companies that have done okay on revenue and missed on earnings, the market punishes. I don't think you want to beat on revenue and miss on margins. I actually think you're better off missing on revenue and beating on margins, because then people think you kind of can handle the cost front.
Got some pricing power and things like that. I'm glad I have you here, and it's fortuitous, frankly, because I'm looking at a headline here. AMD is holding its analyst day, as we speak. You're a former chip analyst.
Right.
AMD is saying, let's throw up the stock. Let's also see it, guys, if we could, on an intraday basis, because this news came out just before the close. We see a quote-unquote down PC market this year, right? Yeah. So Intel was already talking down its business in the last couple of days. Now you've got AMD. What do you make of it? I mean, chips are the quintessential cyclical part of tech.
I think there's a huge difference between chip makers that have perishable inventory and those that don't. Meaning, if you make too many microprocessors, AMD, Intel, or graphics chips, NVIDIA, or certainly memory, Micron, your pricing gets killed and that hurts your profits. But there's a whole other chunk of that business, analog devices, Texas Instruments, those kind of companies, where if they make too many, they don't have to cut pricing. And so I think you'll see a bit of a bifurcation within semis where the quality businesses with pricing power just do much better. So this is the time to own the higher quality businesses with the higher margins, not the cyclical levered ones like AMD and Intel.
Which are the better ones to own then right now? And then we'll move on to another topic.
I would think the equipment makers like ASML, Lam, KLAC, and the like are great businesses.
Lam Research,
Synapsys, Cadence, and I think also Texas Instruments and ADI.
Okay,
those are your winners.
So let me ask you this. Let's look ahead now to the big event tomorrow. Made bigger now, perhaps, by this move into the close, which was ugly. Bigger move tomorrow for stocks comes from an upside or downside surprise. Which one is it, do you think?
I think downside, right? I mean, I think if people start thinking inflation's rolling over, that the Fed action has started to work a little bit, that they see some of that in the data, I think the market interprets that as a positive. As you and I have talked about, I don't think anything directionally hawkish is going to be good for the price to earnings ratio for the S&P. So if we get something where people say, all right, the Fed did some work, maybe they're not going to do 50 bips 4 more times in a row, maybe they'll chill a little because things are slowing, that probably is better for the multiple in the medium term.
Isn't part of this, once again realizing just what's happening around the world? Rates are going up. Right? You got another reminder of that globally today as other central banks are acting in the same manner, most of them, not all, in the same manner as our Fed. And yields are rising, right? 2 years back up, 3 years settled over 3%. If we work back towards that 325, what's that going to mean for stocks?
I don't know. I mean, for me personally, I think the S&P long-term algorithm is something like 6 to 8% total return, right? That's the earnings plus buyback plus dividend. So I have an exaggerated sense of self-worth. I think I can beat that. by owning stocks. So let's say I think I can get 8 to 10. So the 10-year yield needs to be way more than 3 for me to start shifting all my money into it. I don't know if it's 5 or 6 or something way more. So I still think there's lots of opportunities to buy stuff, but I get the tenor of your point. And I think the main thing I'd be focusing on in July earnings that's underappreciated and not being talked about is the labor force for the corporates. Is it U.S. or non-U.S.? Because one thing that's strange to me, but I get it, I guess, is all the wage pressure is in the U.S. All the absenteeism, all the people not showing up for the union contracted rate, it's in the U.S. If you have employees in Mexico or Poland or Vietnam, I think you can handle this wage issue much better, and you may hold up in earnings better than people think in July and in your guidance.